All right, so today is Monday, right? And before we start, I just want you to understand few things here. Consistency is important in our journey when it comes to trading. You can never ignore consistency and talk about success. Every success breeds consistency. Before you can attain what you call success, you need to consist in all your actions, right? So when you become a business person or a trader, your consistency really matters a lot. Even consisting on the same thing over time. When we say someone is consistent, that does not mean he's trying different things at a point in time, but he has been doing the same thing over time. That is what brings success. There is no successful person in this world that I ever know that keeps changing all his opportunities all the time. He keeps consisting on the same thing over time, right? So if you're not willing to pay the price, I don't think you can get what you want. And I've always been telling you, both success and failure has got a price to pay. It's either you pay the price of success or you pay the price of failure. So if you can't pay the price for success, then you should know you are paying the price for failure. If you can't pay the price for failure, then you should know you are paying the price for success. Right? One man cannot serve two masters at the same time. And you should learn to know how to focus on your business and do things accordingly. Hope I'm clear. So today is Monday, and we weren't able to have our technical analysis class. Sorry, I couldn't wake up on time. The weekend was very stressful somehow. Yes, and so we are starting with trade settings this morning. That is going to be a very short lesson, and afterwards, I'll give you the opportunity for you to ask questions, and afterwards, we bring the session to an end. And I hope you are ready. Give me one in the chat for me to know if you are ready. Give me one in the chat for me to know if you are ready. Mm-hmm. Good, 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 good. Okay. All right. So let's go. Trade settings. Now, when it comes to trading, over here in RoyalQ, our focus is for every trader to understand how to easily set up a trade on the spot market and then also on the futures market. These are the two markets that we have, and that is what we are doing, and that is the markets we trade on, right? So it is your core responsibility for you to know, learn, and understand how to set up a trade there and how to apply the various risk aversion tools over there, right? So both on the spot market, and then also on the futures market, you should know how to set up a trade on these two markets. And there is a slight difference between setting up a trade on the spot market and then setting up a trade on the futures market. But when it comes to the risk aversion, they are almost the same, but with different meanings. This is what you need to know. Setting up a trade on the spot market is not the same as setting up a trade on the futures market. But the risk aversion is almost the same. If I talk of the risk aversion, I mean being it margin configuration, call drops, margin call limits, the rules applied are still the same. So that is what you're going to look at this morning. Setting up a trade on the spot market and then setting up a trade on the futures market, how to apply risk management risk aversion tools on the spot market, and then risk aversion tools on the futures market. Then when we are done with that, we bring the session to an end. Okay, so quickly, let's go to RoyalQ. All right, so um good. Now having your RoyalQ app, it's two things. I've always been saying this. When it comes to trading, it's either you are receiving signals, okay, or you analyze and source your own signals. And in all, our responsibility and our focus, our goal here is to ensure everyone can be an independent trader who knows how to source his own signal. That's the reason we've been handling the technical analysis class. So when it comes to trading on the spot market, either you have your signal or you are yet to um, get signal from someone. Now, for the past years, our focus has been that we would have consistent repeated profits. That is the reason why mostly we don't go for huge take profits, but we go for short take profits, right? To ensure that you can easily get out of the market, and get out of the market and being able to recreate new trades, you can be able to win more consistently. Okay, so now on the spot market, let's look at what happens on the spot market. Good. Okay. Now, whenever you are setting up a trade, the first thing that you should take your time to read, even this shouldn't be something new, right? But I've come to realize that most traders don't pay attention to some of these things. Most traders don't pay attention to some of this information. He said cryptocurrency trading carries high market risk. Please trade cautiously and assess your risk tolerance. RoyalQ does not guarantee profits or bear responsibility for trading losses. Take notice of this. RoyalQ does not guarantee profits or bear responsibility for trading losses. So whenever you are trading, you need to know and understand the nature of RoyalQ as a quality product, right? That is just like a roadmap to guide you to make things successful. It's there to guide you. It's a tool to help you align with your purpose, with your goal of trading. So, whatever you are doing, whenever you are trading, he said, be cautious, trade cautiously. And trading cautiously has to do with your setup and your risk aversion. Do you get it? Trading cautiously has to do with your setup and your risk aversion. They said, assess your risk tolerance. That is what we are talking about here. Assess your risk tolerance. Why must we do that? Because RoyalQ is not a product that it's we will say return on investment that guarantees profit for you all the time. No. Do you get it? Neither do they also guarantee or bearing responsibility for losses in trading. So, which simply means it is your core responsibility to learn and understand how you can handle these two things, trading cautiously and then assessing your risk tolerance. Is it difficult? It's not difficult. You get it? As a trader, these are the two main basic information you need to learn to grab and then understand. They said trade cautiously. How do you trade cautiously? By learning how to set it up rightly, and then also assessing your risk tolerance. These two come together. You are trading cautiously. That is, when you say trading cautiously, you are trading with your mind, not without your mind, with your understanding, not without your understanding. That is the reason RoyalQ is a business school for people who want to succeed in trading, right? That is the reason RoyalQ is a business school for people who want to succeed in trading. That is the reason RoyalQ is not a Ponzi scheme. So the day you sign up your bot, you sign up your account to start trading, is the very day you need to wear the cap of thinking and being smart to learn and understand how things work here. Unfortunate for you, you are not going to do this alone. You have tutors, mentors, coach who are there to guide you at the time. So what again? Now let's proceed. I hope I'm making sense to someone here. Hope I'm making sense. Hope I'm making sense. All right. So just click on understand. Now, unlike the futures market, we'll get there. Over here, we have markets, we have bots, and we are focusing on create, right? You are here to create a strategy or create a setup for your bot. So you click on create. We have the martingale and then the grid bot. And soon you may be heading towards the bear. If the bear happens, if we enter into the bear market, we may be using the grid bot, right? But for now, we are using the martingale strategy. So you click on martingale, then you click on create. Mind you, this is for sports trading. This is for sports trading. So you click on understand. Before you understand something, read though. There is that attitude of Africans and most people that they buy products, they refuse to read the terms and conditions on the product. They use the product and they realize there is a problem, then they begin to complain. Who do you blame? You must blame yourself because you never read the terms and conditions apply. What if it was poison? So you always need to read before you click on understand. It is important. You know you don't understand. Why must you click on understand? If you don't agree, don't click on understand. Are we together? Are we together? So anytime you decide to trade, you must know that what you are doing, you are making what you call an informed decision. When you say someone is making an informed decision, it simply means that person is really aware of the outcome of his decision, right? So you are really aware of the outcome of the decision you are making. That is to say, you are making an informed decision. All right. So let's get back here. The next thing is your trade settings. But before then, let's talk about some of these things, which we may talk about them detailed in the next chapter of our lesson. So once you set up a trade, the first thing you are going to see is your position amount. Both on the futures market and on the spot market, you will see position amount. When we talk of the position amount, that is the total portfolio or the total amount your position or your trade is holding. That is your position amount. Right? That is the position amount. So the total amount that your funds or your trade is holding so far becomes your position amount. Then we have the average price. So basically, when we talk of the average price, now the average price is the difference between the so let me break it down for you. When you talk of the average price, that is the amount you keep buying or the price you keep buying at different amounts, right? So let's assume you buy your first buying amount, you bought $10 at the price of $2. Your second buying amount, you bought maybe $20 at the price of $1.5. $1.5 becomes your what? Your average price. So the original price at which you bought the asset is your average price. Hope it's clear. The original price at which you bought the asset. When I say the original price, I mean the price. Either first buying amount, second buying amount, third buying amount. I mean first margin call, second margin call, or whatever amount you bought it. That becomes your average price. So if the price ranges from $1, $2, $3, $4, $5, anytime you buy, that new price becomes your average price. Do you get it? Let me know if you get it. Do you get it? Hmm? Do you get it? Good. Good. Now, hmm, let's look at the next one. We have position quantity. Position quantity. Now, every asset holds a quantity. Now, mind you, we said we are trading Solana, we are trading BTC. The amount that we've been trading is what of the value of that asset, which is expressed in the quantity here. So anytime you see position quantity, if let's say you are trading Solana and you bought $10 of Solana, you see your position amount to be $10, but the quantity of Solana that you bought will be expressed here. How many $10 of Solana will give you how many Solana will give you $10? That is what we mean by the position quantity. So it is both expressed in USDT and then the quantity of that asset. Mind you, we said 1 BTC. Okay. The asset itself is BTC and its equivalent value is expressed in USDT, which is United States theta, right? United States dollar theta. So which is pegged by this value, which simply means the entire asset itself is in what? Is in BTC, is expressed in BTC. So one of this is what we term as BTC, right? But its quantity related value is expressed in USDT. So BTC is BTC. If you want its quantity, that is what it's expressed here. So anytime you see the quantity here, that is the total amount expressed that you bought. If it was in USDT, that has been expressed here. I don't know if you get it. Then the next one, we have current price and then unrealized P&L. Now let me talk about the current price. Now basically when we talk of current price, we get it right from the word current. That is the market price at which the price keeps moving. The market price at which the price keeps moving. So if you bought the asset at $5 and presently sold at $3, $3 is the market price. $5 is the average price. So it was $5. Now you sold at $3. $5 is the average price. $3 is the current price. Do you get it? Do you get it? Let me know if you get it. Do you get it? Do you get it? Mm, good. Very good. Very good. Let's proceed. Now, what about the P&L? This is one of the most interesting parts of trading that mostly it confuses a lot of traders. Now, when we talk of P&L, so the word is unrealized and realized. Unrealized P slash L. Now, the P stands for profit, and then the L stands for loss. So when we talk of unrealized P and L, we mean either a profit or a loss which is not real. Okay, so it is on a paper. It's not yet recorded as a real profit or a real loss. In other terms, you may also choose to call it a floating. When we say something is in floating state, it simply means that thing has not yet been real in an actual sense. It's in a temporal state. That is not the permanent state of it. So basically, when you see unrealized P and L, if it is in green, you will see profits. It's profits. But that is not the actual profit because it has not been sold. And if it is also L, which is loss, that is not the actual loss because it has not been sold yet. It's just the temporal state of the asset. So that is what you need to know. Now, hope it's clear. So anytime you see P and L, you should learn to know that we mean profit and loss. If it is in green, that is profit. If it is in red, that is loss. Now, how do you get to know? This is simple. It's always either green or red, right? So until you close the trade yourself, you can never conclude that you are in loss or you've run losses. So let me say you've run losses of your trade, right? Or you've made profit. If you've not closed the trade, don't force yourself to say you've made profit, right? Profit can only be made when the actual trade is closed. If not, you may see just a floating profit. So it's either a floating profit or a floating loss. Hope you get it right. Okay, let's look at the next one. We have strategy, right? Cycle, sell, buy. What are these keys doing here? Mind you, this is on the spot market. So basically, we have two strategies here. We have the cycle mode and then also the one shot mode. The cycle mode and then the one shot mode. Now, the cycle is there to help you, especially traders who don't have much time, but they always love to trade. When you set up a trade on cycle, the advantage is simple. It helps you to make consistent profit without closing the trade. And mostly this can be done on different assets. Not on every asset, but maybe assets that may be good to you in the market and you think you will have to set them on cycle mode. Do you get it? So if you choose cycle, let me turn it off. If you try or if you decide to set up a trade on cycle mode, once the trade is closed, it will be bought again. If it's sold, it will be bought again. If it's closed, it will be bought again, like that. Hmm? Then we also have the sell button here, sell, and then buy. So in all two cases, you can either sell manually or buy manually in addition to your trade. All what you just need to do is to click on the sell button or the buy button to enable you buy or sell your trade. Hope it's clear. Hope it's clear. I'm taking time to explain this to you because it's one part of our trade settings. Now we have the strategy mode. The strategy mode. So basically, we have three different strategies here. Three different trading strategy mode. First has to do with, he said after the fourth margin call, you may only switch between sub-in mode and sub-in real-time settlement. You cannot switch all from whole warehouse mode. While using sub-in mode, profits would only be shown after all positions are closed. Do you take time to read this? It is important. Before you click on what I understand. All right. So we have the whole warehouse mode, sub-in mode, and then sub-in real-time settlement. And I'll talk more on that when we get to um, the margin configuration. So over here too, we have the initial buy-in price. Initial buy-in price. And this has to do like a preset price, right? A preset price for your trade. So you can also choose to set a preset price at which you will have to buy the trade or buy the asset. So if you've analyzed an asset and you know that, okay, this is where the trade will trigger your entry points. So you can just come to initial amount or initial buy for you to make your entry point here. So that will be your entry. Immediately they get the trade triggers there, it will be bought. Do you get it? Do you get it? Do you get it? So, all right. Maybe I may not get back. So let me answer that question because once we tap onto the strategy settings, we may not get back. So let me quickly answer that question. So how can we set up the price at which the trade is run, the running trade can close? So that is for futures. Okay, that is for futures. So on the spots, we also have the trigger price. So let's look at it. So over here on the spot market, you have the preset price, and then the time at which the trade can be closed is called your TP. That is your take profit. So if you have an exact price at which that is the reason why you've given it a percentage, which is the either 1%, 2%, or 3% that you've given it out. So it simply means you want the trade to trigger when it hits that particular price, which is a percentage profit of that particular price. You get it? So the initial buying price is a preset price. Okay. Then let me see. I saw something. So does the cycle strategy buy the coin at the current price or the price you bought it earlier? So it always buy it at the current price. It always buy it at a current price. That is the reason why the cycle mode is not meant for everyone. The cycle mode is not meant for everyone. Listen, if you want consistent profits and you have more time, or if you don't have much time, that is fine. You can go for the cycle mode. If not, the cycle mode is not meant for you. Go for one shot. Why? Because if you decide to set up a trade, let's say Solana, okay? Let's say Solana, you try to set it up. The price is 120. It sold at 130. Now, when the price drops to 80, since it's sold at 130 and the price finally dropped to 80, maybe fine, you may get it here. But if the price rise to 150, before your trade is sold, it will still buy it at 150. So it always follows the current price. It always follows the current price of the assets. Do you get it? Very good. So with the cycle mode, it's buy the assets at the current price, not the earlier price or the initial price you bought the asset. Okay, so now finally we can click on trade settings, because on trade settings we are going to get in touch with these ones. We're going to get in touch with these ones. We've talked about part of it. This. Right. So let me say something about these two before these few ones before we proceed with I tap on the trade settings. So we have the first buying amount. We have take profit. We have call drop, margin call limits, earnings callback, and then also buy in callback. Now, let's quickly click on trade settings. Sharp. Good. So on trade settings, we have my templates. Choose a strategy settings, strategy mode. So with the strategy mode, like I said, we have the whole warehouse mode, sub-in mode, and then sub-in rate time settlement. And mostly the whole warehouse mode controls from the first call to the fourth call. It buys assets from first call to the fourth call and sells them in whole, right? Or it sells them together. Now, with the sub-in mode real time settlement, the two does the core work, but slight difference. With the sub-in mode real time settlement, you make your profit, right? You make your sub sales as profit. And then with the sub-in mode, the sub sales is distributed back to the market for it to allow or draw your average price closer to the current price. So the difference is that with the sub-in mode real time settlement, you may make profit on the sub sales, that is the margin calls you've opened. You may make profit on them. But on the sub-in mode, such profits will be given or will be added to your trade to help the average price draw closer to the current price. Hope it's clear. So the next thing, you come to your first buying amount. Now, basically, when we talk of first, this is what I want to touch. Basically, when we talk of first buying amount, there is a great misconception about first buying amount. And the last time someone prompted me about it. Now, when we talk of first buying amount does not necessarily mean, let's assume you have $100. Okay, you use $20 to buy a trade. Automatically, your first buying amount is $20. Why? Because that is the amount you've exposed to the market. Listen, that is the amount you've exposed to the market. That is the initial amount. But if you still buy another $20 again, it increases your first buying amount from 20 to, let's assume you bought 20 again. It increases your first buying amount from 20 to 40. If you buy another $20 again, it increases your first buying amount from 40 to 60. If you buy another 20 again, it increases from 60 to 80. In this case, how much is your first buying amount? Drop the answer in the chat box. How much is your first buying amount now? How much is your first buying amount? Maybe I have to repeat this. Listen, you bought a trade, initial price at $20, remain with $80. You still bought another $20 in addition, making it 40. You still bought another 20, making it 60. You still bought another 20, making it 80. Now, in total, you have $80 as your FBA there. You are remaining with $20. The question is, if they ask of your first buying amount on a trade, which is your position amount, how much is your first buying amount presently? Is it still 20 or 80? Hmm? So the amount that has been exposed to the market now is your first buying amount. So how much is your first buying amount? Is it 20 or 80? Let me know. Drop your answer in the chat box. Some are saying 20, some are saying 100, some are saying 100. Did I talk about 100 here? Some are saying 20. Hmm? Mm-hmm. I want more answers. Drop your answer in the chat box. Okay, someone saying 80. Yes, drop your answer in the chat box. Hmm? No. Someone say repeat your question again. Now listen. I'm saying this because it will make the features lesson to be so easy. Listen, $100 is your trading capital. When we talk of first buying amount, the exposed amount of money to the market at a given time, right? The exposed amount of money given to the market at a given time. So first, you bought $20. That is your FBA. Second, you bought $20 in addition to the 20, making it 40. Third, you bought 20 in addition, making it 60. You bought 20 in addition, making it 80. Now, if I asked you, what is your initial amount exposed to the market so far? So the initial amount is your first buying amount or your buying amount. What will you tell the trader? Yes. Is it still 20, 80, or 100, or what? That's what I want to know. That's what I want to know. Now you can drop your answer. Yes. Now you have the question right, so drop your answer. Yes. Some are saying 20, some are saying 80. Yes, drop your answer in the chat box. Drop your answer in the chat box. Yes. 80, 80, 20, 20. Yes. Drop your answer in the chat box. Drop your answer in the chat box. 20. Wow. All right. Now, let's look at it. Listen. Let's look at it. I'm prompting you on this because I've seen a lot of futures traders complain that why must their margin calls be liquidated, right? This is important for you to understand. Any amount of money you expose to the market becomes part of your buying amount, which means you are no longer trading with $20, but you're trading with $80, and that is your amount exposed to the market. So assuming on the futures market, if you are to be liquidated, you won't just be liquidated because you exposed $20 to the market, but any amount of money that has been exposed to the market, if it's supposed to be liquidated, all such money will be liquidated. And likewise on the spot market, since you've exposed $80 to the market, all the $80 will be in floating loss if it's supposed to be in floating loss. I don't know if you get it. So mostly a lot of traders think since I exposed $20 to the market and I bought 5 margin calls, if I'm to be liquidated, it's only the $20 that is supposed to be liquidated. Any amount of money exposed to the market may either produce profits or be liquidated if the need be. Do you understand what I'm saying? Please, do you understand? Do you understand? Let me know. Someone say repeat again. Do you understand? Very good. Now, for the sake of the person requesting to repeat, this is something simple. Being it on the spot market or on the futures market, this is important for you to understand. When you set up a trade, when we talk of the first buying amount, that is the exposed amount of money in the market, right? The exposed amount of money. So the next time that you come, if you come here and you don't see 80 and you see 100, that is the first buying amount now. Why? Because $20 has been added, has been exposed in addition to the 80, making it 100 now. Which simply means if I'm to be floated or liquidated, it is the $100 that must be liquidated and not the $80. And I'm saying this because a lot of people get into my DM, they ask me, I set up margin calls and I got liquidated my first buying amount. So you see, that is the reason I'm explaining this to you very well for you to get it clear. That any amount of money that you expose to the market, either being it profit or loss, especially liquidation, if you are to be liquidated, it wouldn't scare. The most important thing is you've exposed that to the market. So the amount you've exposed to the market If your initial amount was 20 and you so added 20 to it again, now your first buying amount is no longer 20 but rather what, 40. It increases as it keeps buying the margin calls. Now listen, margin calls are not they are reserved money. Do you get it? Once it's add up, it become part of your first buying amount. Then added up to what you've bought already. So it's very simple, and I hope you get it now. I hope you get it now, my dear. I hope you get it now. I hope you do get it now. Mm-hmm. Joma, I hope you do get it now. All right. Good. Good. Now we can proceed. Now we can proceed. So over here, we have your first buying amount. Then we also have enable double up, double opening. Now you don't need this. When you talk of the double opening, that is if you've bought, let's say, your FBA is 80 and you turn on the double opening. That simply means if you're supposed to buy, it will keep doubling the first buying amount. So over here, if you bought 80, a double of $80 will be bought again for the next one. A double of it will be bought for the next preceding one again, in that order. That is the reason you don't need a double opening. Unless maybe you have huge funds to trade, fine, you can do that. And if not, I don't advise that. Okay, good. So let's come to the parameter settings. We have the margin call limit. Margin call limit. And when it comes to my trading class, what I've been saying is that no one should decide the amount of margin calls to be used, except you've identified your capital to trade. Since I don't know the capital, the amount of money that you are using to trade, I may be wrong to decide on the number of margin calls to use. 2, margin calls. Margin calls is based on the assets. Do you get it? Margin calls is based on it's based on the assets. Do you get it? Margin call is based on the asset you are trading. For instance, someone trading Bitcoin and someone trading maybe Jelly Jelly, right? Someone trading BTC and someone trading Jelly Jelly. Even if you're all trading with $100, don't expect us to open the same margin calls. Do you get it? So if you are trading with BTC and I'm trading on Jelly Jelly, and even if we are all using $100, don't expect we all trade with the same margin call limit. Why? Because these two assets have got two different risks. If you understand what I'm saying, give me one in the chat. If you understand what I'm saying, give me one in the chat. If you understand what I'm saying, give me one in the chat. All right. All right. Very good. Now we can proceed. So it is important for you to know, learn to understand it today. You are crafting your own growth, and don't wait for people to decide on what you should do. It's about understanding. If you understand what to do, you can create or craft your own method on what to do. That is how knowledge should be. Knowledge shouldn't imprison you, but knowledge should give you the opportunity for you to think free and make personal decisions. You get it? Very good. So when it comes to margin call limits, let's assume you decide on the amount of margin calls to open, let's say 10, then you take profits. You take profits, which is 3. Now, why 3%, 4%, 5%, 1%, or whatever? The take profit is such that the higher your take profits, one, the more you can be what? Delay. That is one point that you need to do, what you need to understand. Do you get it? The higher you take profits, the more you can also be what? Be delayed. So if you want consistent and then reoccurring profits, then it's advisable you reduce your take profits so that you can be able to make consistent profits without staggering in the market. And this is real. Now let me ask this. If to know if you've understood what I'm talking about. Between someone with a take profit of 2% and someone with a take profit of 10%, between these two people, who get out of the market very fast? Between these two people, who get out of the market very fast? Yes, between these two people. Someone with a take profit of 2% and someone with a take profit of 10%. Between these two people, who get out of the market very fast? Yes, let me know. Very good. Very good. Very good. Now, why would that person get out of the market very fast? Yes, because his take profit is less as compared to the person with the higher take profit. Since he's having less targets, he may be able to achieve that target faster and easier as compared to the person with the higher target. And that is trading. You get it? That is trading. So if you understand some of these things, you wouldn't let greed push you to make decisions that will hurt you. And that is a challenge a lot of people are facing, especially those who analyze signals. They don't need, they don't learn to say, okay, at this point in time, let me only go for 1% or less of that. And instead, going for huge take profits. There is nothing wrong with going for huge take profits, but you should always understand the risk involved. All right. Then let's talk about um take profits, callback, buying callback, and then also start position take profit callback. Now, as we have the take profit 3%, the callback, that is when the price rises and drops to a percentage of 0.3, sorry, 0.1, you are expected to make a profit of 3%, right? So once the price rise and drops to a percentage of 0.1, the take profit should be triggered. That is the meaning of the callback that we've been talking about. So mostly the buy-in callback, the work of the buy-in callback is to ensure that if the price goes beyond a certain target, you can easily make extra profit on your trade. So let's assume though my take profit is 3%. Since I have a buy-in callback of 0.1, when the price rise beyond 0. When the price rise beyond 3%, I can easily make 4% or 5% or even 20% on that same asset. Do you get it? So if you don't want any back and forth profit to be triggered, the easiest way you can do is set up your take profit to be your callback to be zero. Zero. When you set up a callback to zero, it simply means you don't want any extra profit, and you don't want the trade to keep long in the market by waiting for extra profit to be earned on the trade. Why? Mostly in trading, when there is high resistance, extra profit is easy to be made in trading. When I say it's on high resistance, sometimes an asset may be rising very fast beyond the original peak. Do you get it? But if I have my take profit callback to be zero, immediately I set it up to zero. Once the assets rise to trigger my take profit, immediately I'll be in profit without waiting for any extra profit to be earned on the trade. Do you get it? Let me know if you get what I'm talking about. Do you get it? Do you get it? Do you get it? Someone say come again. You get it? Let me know if you get it. Let me know if you get what I'm talking about. Mm? All right. That is good. Now listen. Listen, my brother, listen. Listen. What we are discussing about is very simple. I need you to listen to this. Listen. Mm? We are recording the Zoom, so please, those turning on your videos. We are recording the Zoom. All right. Now, what we are saying is this. You set up a trade, right? You set up a trade, your take profit is 3%. There is either a high resistance that can let you earn more than the 3% in the market. But when I have my take profit set to zero, all what I'm saying is I don't want to wait for this high resistance. All what I want is my 3%. I don't want any extra profit here. No matter how good the market is, I don't want it. This means you don't want to waste your time in the market. That is the meaning of going for a take profit or a callback of 0%. So no matter the resistance in the market, all what you expect is your 3% take profit. Even if it will give you less, you don't care. But you don't want more. That is the meaning of the 0% take profit call, the buy-in callback. Hope it's clear. Hope it's clear. Hope it's clear. So mostly trading on the futures markets, it's more advisable, or it's okay for you to use a callback of 0, so that it wouldn't waste your time whilst the market reverse. Do you get it? So that your time wouldn't be wasted in the market. That is the point. So mostly, if you have a callback of 0%, you are just doing so to ensure that at least your little profit that you've earned can hit in your account without the market reversing back or reversing, right? So that is what we are talking about here, and I hope it's clear. Hope it's clear. Hope it's clear. Are you guys sleeping? Hope it's clear. Hope it's clear. There are some of you, you join the Zoom, then you sleep. You put your phone or your laptop elsewhere, then you sleep. It's not good. Hmm? So you respond for me to know if you are so active here or I'm here alone. All right. Now we can proceed. Now we can proceed. Okay. Now let's look at the distributed take profit allocation. The distributed take profit allocation. Now, this mostly works for your callbacks or your margin configuration. Margin configuration. So from the fifth call to infinity. From the fifth call to infinity. Which simply means if you set up, or if after the trade has been bought, your margin calls has been bought, you can decide on the amount of profit you want on the margin calls. Even though your take profit is, let's say your actual take profit is 3%, and you think you still want 3% or 2% on each call that is to be bought, no problem. You can come here to fix it out. So you can come here, you make it 3%, 4%, 2%, 2%, 5. Even if it is 10, listen, there is no fixed formula here. Why? Because remember, the more it buys the asset at a lower price. You get, the more the asset drops, the more it buys them at a lower price. So if I bought this one at, let's say, the price of the asset was Solana was, let's say, $20. Now I bought this one at $19. Now I bought this one also at $15. I bought this one at $13. I bought the next one at $12. The next one at $10. If I decided I want to make 10% on this $10, 5% on this, 5% on this, it's okay. It's my decision, provided I know the assets I'm trading. Hope it's clear. So always you can choose to adjust your distributed allocation take profit callback. Now let's look at the advanced settings. Then we talk about the futures market. Then we bring the session to an end, or you ask your question. So over here you talk about the one shot, and then we also have the trigger price. The trigger price. So on the trigger price, let's click on it. When we talk of the trigger price, like just as we have preset price, so preset price, and then trigger price. So the trigger price works just like a current price. So if you have your trade at a preset a trigger price, it simply means you want it to be triggered at the exact price to which you've set up your trade. If it is current price, it will be triggered. Mind you, you have the RSI, the KDJ, and then also the MACD, to which we may talk about them another time as part of our lesson. But for now, it's not part of our lesson for today, right? So just make sure that anytime you set up a trade, you are just focusing on the trigger price. Or if you have an optional trigger price, here is it, you can also enter it here. Do you get it? If you have an optional trigger price, you can also enter it here. That's all. After that, you save your trade, click on confirm. Very good. Then you click on what? Activate. That's all for the spot markets. So the same thing works also on the futures market. On the futures market, what the slight difference is here? This. So we click on futures, you select any of the assets. Now, create. I understand. So on the futures market, either you are trading on long position or short position. Either long position or short position. Afterwards, the next thing that you have to do, all these features are still the same. So good. On the futures market too, if you want to close the trade manually, just like on the spot market, if you want to sell, you click on sell. Over here, we don't sell, we close. So it's either you want to close the trade manually, then you come to the close button, you close the trade peacefully. Now, click on trade settings. They'll manually create. Afterwards, the only part that I'm going to touch, then I end the session or I give you opportunity to ask your question, is this. This. Right? Now, mostly a lot of people get this thing wrong, calculating it anyhow. If you want to make more profits, it depends on how you calculate this together with your leverage. Where is it? Together with your leverage. That is what generates the profit for you. Do you get it? So let's assume, how do you calculate this? This is a short formula that I'm going to give you, a simple one. Now, your unction, the value of the asset, that is 1.06 divided by 5.012 times your leverage, which is, let's assume it is 20, so times 20 times your actual capital that you want to use to trade, which is maybe $20 as well. Just go and use your calculator, enter the values, get the answer, come and enter it here. That's all. Enter it here. So let's do this. Let's do this together. 0.06. Let's take our calculator. 0 point, is it 0 or 1? 1.06 times 5.012 times 20, which is the leverage, times the capital that I want to use to trade, expose it to the market, that is $30. So making 3,187.6. Let's see. 3,186.87. Are we doing the right thing? Let me see if we are doing the right thing. It was 1 point what? 1.6. Let's change the assets. Now, let's look at it. Uh, I just want a very new setup. Okay, let's use this. Okay, so look at this. 675 divided by 5 times the leverage, let's assume is 20, times the capital, which is 30, right? So let's look at it. 275 675 rather, 675 times, sorry, divided by 5 times 20 times 30, that is 81,000. 81,000. Good. So your leverage is 10x. So your capital, your actual capital is what? Is $30. But because of the calculation that you've done, now you have $600, right? That you are using to trade. If you can do this, you always trade and make good profits. The calculation is the most important thing. But if you can't calculate, you always struggle to make profits. That's the reason why people use $1 to make $2 and stuff. $1 to make $1 to make 0.5 and stuff. $10 to make $2 and blah blah blah. You see, it's because of the calculation. Let me know if you understand. Do you understand? Do you understand? Okay, so Sylvia is saying, can me give me the calculation. Divide not times. Okay, so do you understand what we are saying? Now, look at it. Um, let's go back. Sylvia, follow this trend. Which one is this? So, Sylvia, what we are saying is this. 311 divided by 5 times your leverage, which is 20. I'm not saying go and use 20x leverage. I'm just making an assumption. Times your capital, which is $50. So let's look at it. Let's do the calculation together. 311 311 divided by 5 times 20 times 50. That is 62,200. So we come here, 62,200. That is going to be 1,001, right? So your take profit is what? 20. Good. 20. Having this, you are done. Okay. How did you manage to get this $1,000 with a capital of $50? It's because we're able to do the calculations right. Please hope you get it. Do you understand? Do you understand? So Sylvia is saying, is the 30 you want to use for the whole trade or what you want to use as FBA? Yes, so that is what I want to expose to the market as the initial amount exposing to the market. All right. All right. Okay, so guys, if so someone is asking, is the $50 the one that, so that's the what that is the amount I want to expose to the market. That is the amount I want to expose to the market. All right. If you have any question, you can ask. I guess we've spent an hour and 30 minutes here. We spent an hour and 30 minutes here. It's enough. The Zoom is recorded. You can, at your free time, you can go and watch the recorded version on our YouTube channel. That is RoyalQ Evolution. So, um, so someone is asking, what is the profit? Assuming it hits TP. So that one may depend on your profit target. So let's assume our take profit is, let's say, 2%. Let's say our take profit is 2%. Okay, 2% of what? 2% of this. 2% of 1,000. So let's calculate and see. That is $20. That is $20. Hello. All right, guys, I'm back. It seems the network. So okay. So those who want to ask questions, you can ask your question before we bring the session to an end quickly. If you have any question to ask, you can ask your question. All right. So those who want to ask question, you can ask your question before we bring the session to an end. Sorry for the interruption. I guess it was network issue. And okay, so let me see. Okay, so no, you don't have to come back to change the initial first buying amount. It's always constant. So you don't need to come back and change it. Once the first buying amount is bought and the margin calls are bought, it keeps adding up automatic. So you don't need to get back and change it. All right, I believe that is all. I believe that is all. Yeah, so I guess you have to rewatch the video. If you didn't get it, you have to rewatch the video. All right, so I believe that is all. If there is no question, we'll end here. I believe there is no question again. So Sylvia is saying one last one. I don't know if you mean one last question or what, but I've not seen any question here. So all right. So guys, since there is no question, we will end the session here if God permits. We have business presentation this evening. Get prepared. We have business presentation this evening. Let's get prepared. We shall meet there this evening if God permits. So we will end here for today. We shall meet again tomorrow if God permits. In the absence of no question, no suggestion, no omission, we bring the session to an end. We shall meet if God permits tomorrow. I wish you all the best. Let me see and have a good day. Okay, so Sylvia, if I want to use $100 for trade, $20 as well, while calculating for the margin cost to multiply the $80 by the leverage. I'm not getting you. I'm not getting your question. Anyway, you can chat me on WhatsApp, right? Yeah. So I believe we can end the session here for today. If God permits, we shall meet again tomorrow. Thank you and have a good day.